When startups try to raise funding from external sources, they lack track records and legitimacy, without which external investors may feel uncertain about their true quality. It is widely believed that being endorsed by prestigious government programs such as subsidies would signal the quality to those external investors. But is that really a signaling effect? In other words, do investors genuinely believe that government officials can identify high-quality startups? What if some corrupt officials offer subsidies to particular firms in exchange for private benefits? And if subsidies can be a signal, does their signaling effect vary across different types of subsidies? Our study tries to answer these perplexing questions. We take advantage of China's most famous anti-corruption campaign, which is called 8-Point Code, to perform a quasi-natural experiment because its first inspections in provinces were staggered over 2 years. We focus on two major types of entrepreneurship subsidies. One is R&D and the other is high growth. Based on the difference in differences analysis of 584 IPOs, we had very interesting findings.
For R&D subsidy, we found that regardless of corruption, they are always matched to high innovative firms. It suggests that government officials are always able to tell who is more innovative. However, investors would question whether the government can effectively stop firms when corruption is high. So they only interpret R&D subsidies as quality signal when corruption is low. Essentially, what information do R&D subsidies convey? We believe that firms disclose more details of their technologies to government officials than to the public, and R&D subsidy help close this information gap. High growth subsidies are, however, very different. They are matched to high sales growth firms only when corruption is low, but fail to do so when corruption is high. However, even when corruption is low, investors ignore high growth subsidies because high growth is unpredictable and not persistent, and therefore they do not believe officials can identify who would become high-quality firms. In our supplementary analysis, we further find that R&D or high-growth subsidies do not influence firms' future innovation or growth after IPO. It means these subsidies do not have a treatment effect on firm quality, and thus investors' reaction is purely driven by signaling. In sum, by examining the two steps separately, first, how subsidies matched firm quality, and second, how investors interpret subsidies, we are able to isolate the signaling effect of entrepreneurship subsidies from the treatment effect. In a sense, we have differentiated two major types of entrepreneurship subsidies and their distinct signaling role in influencing firms' IPO. So this is our story.
We hope you like it and have found it elucidating, interesting, and useful.
Thank you for listening.